What's up, everybody? Welcome to another Ask Me Anything Happy Hour. You guys got your drinks? I got mine right here. Nice little, sparkling water. Yep. So everybody, go ahead and get any questions you have into the chat box. So by the way, guys, Ask Me Anything is for you guys to ask any questions about whether it's infinite banking, whether it's annuities, whether it's real estate, whether it's retirement. Ask us anything you want. That's what we're here for. So go ahead and put those questions in the chat box. We'll go ahead and go around the room here in just a moment after this short message.
We lost Linus.
Oh, you lost Linus. Oh my gosh, where'd he go?
Somebody look for him, quick.
Yeah, quick. You think I would make him
He's
dance
trying
again?
to get that tickets for BYOB.com 3-day, and he's trying to remove it. So he's probably in the system somewhere.
There we go. There we go. All right, everybody, once again, go ahead and get those questions in the chat box as we get more people coming into the room. But I'm your host, Brian Fouch, here up in North Idaho. Not sure what we're going to be doing the rest of today, but we're building a big deck off of our house, and my well pump just broke, so that's fun too. So the joys of living in the country is you got to fix everything yourself. So that's going to be my afternoon, is fixing a bunch of broken stuff. Got a broken down tractor, two broken down tractors.
You're a handy man, my friend. You're a handy man. I'm always impressed how much you know, how much you can do, how much you can fix.
Well,
pretty exciting. You're like the modern Da Vinci. How's that? That's why you're bringing foods.
Something I wouldn't mind actually hiring someone to come and fix all this stuff. But yeah, it's challenging up here because people don't want to travel an hour to come to your house to go do a little repair. They don't want to do it because where I live, I'm pretty far away. But anyways, with that, I'll hand it over to Tess, and there's Linus. Going back.
Yeah, I'm Tess Hulick. Grateful to be here with you all. Like I said before, I came to this thinking it was a scam, and when I found out how amazing it was, I joined on with everyone. And I'm going to say, Brian, my dad is older now, like mid 80s to late, close to mid to late 80s. And I kind of miss the handyman. It used to be, hey, Dad, the blinker's out. And he'd say, stop in, I'll change it for you. Yep. Not anymore.
That reminds me of my grandfather with my mom, the same way. Every time we'd go to his house, which was 3 hours away, he'd make sure that he checked the oil and checked the coolant and everything before she'd go back home, drive back home. He'd always do that every single time, no matter what.
Yeah.
So, yeah.
Taking
a lot of love.
Yeah.
Yep. Who's next?
Jason.
Oh, yeah. Hi, I'm here. I'm here in Orlando, Florida, like always. Happy to be here. Happy to answer questions and just have some fun, too. I got a story that I might share. I haven't decided yet, but it's an interesting one. I'm gathering more facts, and I'm hoping that what I'm learning is not actually true. So I'm going to leave it at that and pass it over to Linus.
Thanks, Jason. I'm interested in hearing what this is. Hey, everyone. Linus Note here from Hopkinsville, Kentucky. Happy to be here and also help answer questions and give any context or insights that I can. This week, I've been working on a lot of my own bookkeeping. I tend to push that off and help other people, and then my bookkeeping falls behind. So, yeah, definitely got to keep the tax book where it kept up. But yeah, also helping people with policies and setting up systems and servicing their systems, anything I can help with. So y'all get your questions in the chat box there. We're here to help in any way we can.
I know the best person in Minnesota. We can get to that one.
Yeah, I like the question. Where's everybody? So some people are traveling right now. So I know Steven's traveling somewhere. Not sure.
He's in a mastermind. Yeah.
Yeah, I'm sure everybody else is. But that's fine. So this question, we'll cover this one real quick. This is from Mercy saying, I have some debt from 2017 college that I have paid, and I got the confirmation letter, but still last night received a reimbursement letter after all these years, told me I still owe them help. So, well, obviously I don't know your situation there, Mercy, but I would just, whoever is the debt servicer, whoever sent the letter, I mean, you got to call up, because if you have a letter that says you paid it, and you got one that says you still owe it, I mean, I hope it would come from the same person. So they got their wires crossed is what I would guess, but I would just give them a phone call.
Yeah.
Not surprising. I would definitely pick up the phone immediately and start going down that rabbit hole trying to figure that out. So
yeah.
Good advice, Mr. Foots.
Yeah. Let's see here. All right. So this is that question. So David's asking, who's the best whole life person in Minnesota, Minneapolis, to set up an infinite banking system?
I point at this guy. I don't know if you guys know anybody else yourselves, but yeah.
There's a few that are Minnesota.
Yeah. So David, so we'll I'm going to put in the chat box here in just a moment our call link to grab a time with one of us. So the best person is not location specific, in my opinion, because once again, there's not a whole lot of true infinite banking practitioners in the U.S. There's not like thousands of them, in my opinion. There's less than that. And so, and we're licensed, and our brokerage is licensed in all 52 states, or states plus, obviously, Puerto Rico and Guam and the Virgin Islands, those kind of things. So we can do those policies in any of those areas. So it's more about who's the best person for you. And then we do video calls. So all of our calls are on video like this. So just grab a time. Anybody else?
No, I was just thinking the same thing. It's not state specific. It's your situation specific. So you just have to find somebody that understands and is willing to listen to exactly where you're at today and have that conversation and help you get where you're going, right? Meet you where you're at and take you where you're going and help you find that specially engineered plan for yourself. So.
And I think, and it hasn't come up in a while, but you can shop. If you talk to somebody, you go to another one, whoever resonates with you.
Ooh, yeah, I don't do shopping.
You know,
No,
if he's got you, he's going to tie you up and you can't get away.
Nope, no shopping, no shopping. It's meet you where at, tell you what we're doing. If you want to work together, great. If you don't, that's cool too. So you come to me. I'm just saying, you come to me asking me for like, hey, I'm shopping around getting illustrations. Nope.
No. That's not what
doing that.
That's not what I meant. If you connect with somebody and it's not the right personality match, then you don't move forward with them. You don't get 4 people taking you down the road.
Yeah. But I do say, Jason, I do love it when someone comes to us and says, hey, I'm talking to these other couple groups on infinite banking. I'm like, go for it. I'll have a call. And they're like, well, why do you say that? I said, because 9 times out of 10, you're going to come back to us or me.
Yeah, exactly.
Because it happens time and time again. They go have those conversations. And then this is why. So everybody's listening. This is kind of why. They'll bring the illustrations the other group built for them. Within 10 minutes, me or us will explain that illustration better than the person that created that illustration. So the client's like, wait a second, you didn't build this thing, but you explained it 10 times better than they did. Well, kind of makes the choice kind of clear right there. But that happens a lot, by the way. Well, not a lot, but often enough.
It does happen. You're right.
Yeah, often enough.
I don't like the shopper ones, O'Brien. I love that you're able to do that. I find not the same kind of scenario because they're not even listening to see. They just come in saying, how much does this cost? What, how much can I get for this? I want to do this and I want to do all these things. It's like, well, there's all these variables, parameters. I don't understand what you're trying to do. So it'd be like going to the doctor and be like, oh, my throat hurts. And they give you like a bandage for your ankle. Right.
No, I agree.
Right.
So,
it's like, or whatever. Right.
That's
ridiculous is my point.
Yeah.
Right.
The reason why I think they come back to us though is because we ask the questions of them. We're not sitting there trying to sell them a policy because that's not what we're trying to do, by the way. We're trying to help you solve a problem. Until we know what the problem is, we don't know how the policy is going to fit, or even if it is going to fit.
Okay.
And so our conversations, I think, are structured a lot differently than other people because of that, because we're trying to help you and trying to help solve problems. But we got to understand what's going on first.
Yeah, not a process, not a product. A process, not a product.
Yeah.
Exactly.
Keep it in less words.
Yeah. And I have seen other conversations from other agents. And the problem is they're just talking about the product, and they're pitching, selling. They're not helping. They're not solving. So in that regard, to me, they're not providing the right kind of value.
Yeah.
So, but yeah, we can go on that kind of all day long, but that's what I believe. Strawberry sweet. Okay. Says, I'm thinking about doing infinite banking. I would have some money to dump in. So that's a dump in. I guess I wouldn't know what the monthly cost would be unless you actually set it up, right? So who wants to take that one? That's a good question.
I have a question for you guys because I want to hear your opinion. I saw this one. I've been wanting to talk about it, but I've been holding off till we got there. So Strawberry Sweet, thank you for having the intention to do this and seeing that there's already value in it and then just not understanding it yet. Now, what I want to ask the panel is, I don't know how to approach this because when people come in and they're like, how much money does it cost? How much this? It's more about what you're doing and what you want to put into your system and what you're trying to accomplish. So I don't like any of the answers we typically give. How's that for like 10 times this? Or I like the rule of 10% of what you make up to 30% or 20 to 25%, depending on, how much you're saving. So how do you guys answer this? How do you look at this to take someone's mindset and change it here?
Well, one, I always say, let's get rid of the word cost out of the equation here, because the real question is how much do you want to fund and build your policy with each month? Because keep in mind, when we call the premiums not a premium expense, but a premium deposit, because you're depositing into your system that's going to give you value back out. So my answer to this one would be, how much is the monthly cost? As much as you can put in that you're comfortable with. The more you put in, the more you're going to get back out. So it's not about, when people ask that, what I interpret is they're thinking, okay, do I have to do 500 or can I do less? Is it going to be 1,000 or can I do less? What's the least amount I can do? That's the wrong mindset. The right mindset is how much can you put in to accomplish the goals that you're trying to achieve?
Yeah. The word cost is what it gets me stuck, right?
Yeah.
That's why I want to have the conversation openly like this. The word cost means that you're already thinking that this is like going out and getting car insurance, home insurance, health insurance. How can I pay the smallest amount for the most versus like, here's one, solve this math for me. A guy I was talking to has done really well in his life, but right now he's in a really tough spot. He's like 65, just got divorced. He's actually has a policy. He's been banking for a couple of years. And through the divorce, through getting his knee replaced, he hasn't been able to work the way he wants to, doing the real estate deals he wants to. So he's racked up a bunch of debt, like close to $1 million in the last couple of years. And then he wants to know, like, why isn't my policy working? And like I looked, in the first year, he put in the premium deposits that were scheduled, about almost $12,000. In the second year, he put in like $2,000 or $3,000, whatever the minimum amount that he could put in was. And he wants to know, like, how can he use it to get out of debt? Why is it not working? I'm like, you're undercapitalizing. You're not paying yourself enough. Like, do you know how long it would take? I did the math to actually use $1,000 a month policy to pay off $1 million in debt.
Forever.
Forever. It was longer than he had. He'd have to make it to 165 years old to be able to have that work. So it's what you're putting into your system to solve your problems. And you have to stop being last in line for your money.
Yeah.
You got to pay yourself first.
But Strawberry Sweet, once again, I'll put in the chat box here in a moment, the call link. Just grab a time with us so we can go through a bit more of your situation, what you're trying to accomplish, your personal numbers, and that can help you out. So that can give you a better idea.
Yeah.
And I love how you're thinking. You're talking about what's the dividend yield? What is your money going to be doing? Just know that you're putting in a foundation where it's growing guaranteed contractually. All the mutual carriers that we use have never missed a dividend. So we can't guarantee it. You're pretty likely you're well over 100 years. And then it's also protecting. So you're giving your money 3 jobs. So.
Yep. And we'll get to your other question in just a second. Here's another good one. So my question is, this is from Christian Mara, obviously you know him. So my question is, my first policy year is the 28th of this month. So your first anniversary is what I'm assuming of your policy is the 20th of this month. I've been paying base premium and I have room to catch up my policy. If it goes into second year, can I catch up the previous year? What insurance company is he with? You remember?
It is with One America.
One America.
So then the answer to that one is yes, you can catch it back up in year 2. In most cases, correct?
Yeah, just whatever amount had been illustrated originally. So that
but
is
the year 1 can rolls to year 2, correct?
Yeah.
Yeah. Because the Lafayette is the opposite. They don't do that, correct?
No, they would do the same thing. I think their catch-up windows are actually both equal, 4 years, or is it 3, something like that?
Okay. Oh, cool. That's good to know. I didn't know that. All right. So yeah. So Christian, you don't have to do it before the 28th. Is kind of what I think you're asking. So you can do it after the 28th. You don't lose that ability to catch it back up.
Yeah, just keep asking the question: how much additional paid up additions can I put in this month for your policy? And they'll give you an answer every month.
Yep. All right. This is the second question from Strawberry Sweet. Is asking, I'm thinking about doing infinite banking. Whoops, wrong question. We already did that. I can do the second one. There it is. All right. What's the dividend yield the policies are giving right now, and how often do they change? I want to invest in real estate and have my money circulate back to me. It's a great question. So Who wants to take that one? That one's it's an interesting question. Dividend amounts are always an interesting question to answer.
Well, because it's going to vary every year.
Mm-hmm.
Well,
at face value, I can answer, the policy has a guaranteed growth and plus dividends, both combined come out to around 6% annually. So, I mean, that's kind of a starting point to just know in the back of your mind, but it's not going to operate linearly like a savings account or a bank account where you can track, hey, exactly this percent. So here we are. It's a life insurance product, and so there's little expenses in there. There's a little commissions in there. There's things that come out because you are paying for a death benefit as well. So there's more to it. Infinite banking is more about how you're using your system, not the product itself and its growth. But it is a cherry on top.
Yeah.
And the dividend, it's calculated every year because remember, as mutually owned insurance companies, we're owners of the company. So when they take a look at the year-end statements and there's profit, that's what they distribute back out in the form of dividends. So it's not going to be an exact amount because there probably is not many businesses that could tell you to the dollar what their profit's going to be every year.
Yeah. So it's actually, you can calculate the amount after the fact.
After the fact, yeah.
Right. But there's a forecast, but the forecast from what we have experienced, like when you look at your illustration, it forecasts 20 years down the road.
Yes.
Hey, where am I going to be at 20 years down the road? Well, from people that have had policies that are about 20 years old, it's very accurate. I mean, they're very close to that same number because the dividend rate doesn't change drastically. You think of the insurance companies like a huge freighter or container ship in the ocean. It takes them miles to slow down, miles upon miles to turn. They don't operate quickly because they're so long-term focused. These are the same way.
Law of large numbers. There's huge numbers in there. It takes a lot to move them.
You guys had a lot to say on this. I was just thinking, hey, have your money work 2 times.
Yeah. And then
have your money work 2 times. Have it work in the policy where it's always growing, and then do the and both where you're putting it into the real estate to have your money make you a spread.
Yep. And the real estate thing, awesome. Just kind of obviously depends on what kind of strategy you're trying to do, all that kind of stuff, and how the policies fit. But we can always walk you through different scenarios on how to use the policy for real estate because most of us have done it. Let's see here. Levon Lucas is saying, hello, my aunt passed, so sorry to hear that, and left a paid off house. That's nice. And some income is on the way. What would be the safest investment and how I can leverage a paid home? Well, one, we don't provide financial advice. So keep that in mind. We don't provide financial advice. Now, if you're asking about infinite banking and the house, that's a one-on-one kind of conversation. But the question I would be asking you is, what do you want that income or that cash or that capital to accomplish for you? Like that's really what I would be asking. But anybody want to address that? How can I leverage a paid home?
All-in-one HELOC. I mean, access the money in the HELOC. Did you already say that? I mean, that's the first thing I thought of when I read this. So
I would say there's 3 main ways to leverage a paid home. Sell the home and you get cash. That's pretty straightforward. The second way is a cash out refinance loan. So you get a mortgage and you get cashed out of the house. Now you got to pay a mortgage. And then there's 4 ways, but the third way is a HELOC, which unlocks the equity. You don't have to borrow from the HELOC until you have a need for it, but it gives you access to it and gives you the ability to keep the home. So what's the 4th one? There's another way too.
Rental. Turn it into a rental.
You can leverage it. Yeah.
There's also a home equity agreement where you can basically be advanced a good portion of your equity. Then you don't have payments, but you are allowing this other finance company to share in the equity, so they get paid out whenever it sells or gets refinanced. I generally don't like those because you're capping all of their percentage of the upside in equity is now all theirs.
Yeah, those are pretty dangerous, and I've heard some horror stories about how they try to pitch them and stuff. And then, of course, if you want to just turn the house into cash flow, so the rental property, a lease to own, owner finance it back out in the back end. It just depends on your experience, what you're trying to accomplish. And one of my clients one time had the same scenario. They came into a house, they rented it out. They got, I can't remember if it was a mortgage or a HELOC on that home, borrowed from that and used that to go buy a duplex. So they started using the one asset to create more assets. So think of that one tree as a grown tree with seeds and plants and fruits. Take those fruits, go plant another tree, create an orchard, right? You don't want just one tree, you want an orchard bearing the fruit. That's going to separate your risk out and spread it out a little bit if that's what you're going to do. That'd be something that I've seen a client do before. That makes sense. Let's see. Lynn Green has a question. So my question is, I think I keep coming up with, I owe my interest on my policy, but I have a few credit cards I would rather pay off. Is that still a good way?
I'm not sure I understand the way that you're talking about or asking about, but
I get it. What she's asking. She's saying, hey, should I pay the interest on my policy or pay the credit cards? Almost always it's going to be better math to pay the credit cards because you want every dollar you have going to the high interest that is stealing your money right now. Your policy is going to be low interest. So that's going to be the least priority to pay down because of the interest rate. So our software, the Vault software, does show this. It rolls all the money into the next debt unless it makes sense to pay something else first. But it's just math.
And most likely, if there's interest on any credit cards or interest on anything else, it's going to make more mathematical sense. Just my experience of running the Vault probably thousands of times now, it's going to make more sense paying down the high interest amortized debt first before you're paying the policy loan. You're just going to pay the policy simple interest each year annually would be the approach, right? So, I mean, there's a lot of different ways to think about this, but mathematically, that's usually the way it kind of works out.
Now, one caveat I would say to this one is, do you have like a HELOC or something like that? If you're using that, if you're not, but you have a policy loan that is growing, there's a way to do all of this at the same time. And that's where you can do velocity banking, a version of velocity banking on your policy loan to further reduce the interest there, which accelerates the entire thing. Now, if you don't know what I'm talking about, that's fine. But it just means we're going to run your income through your policy loan and then back out again every month to lower the balance, to lower the interest rate. But you're still doing what you're asking. You're still taking as much cash flow as possible going to the credit cards. She has another follow-up here. She says, there is no interest on the credit cards yet. That's why I thought I would pay them off. I have 2 HELOCs that I've been using a bit. Okay, so Lynn, you got a bit more going on in your situation. I think we would need to have a better picture to give you better advice. So if you have a policy already, I'm assuming you have a money mentor. I would reach out to them if you know who they are. If not, just hop on a call with one of us and we can go through the scenario as well.
Yeah, Lynn's an old timer. She's been she's been around the campfire for a number of years.
Well, nice save, Tess. Nice
yeah, I'm like, wait a minute, that didn't come out right.
Yeah, she has 3 policies. Yeah, we recognize her for sure. That's cool.
So can I share the scenario? Yeah, because I'm becoming dumbfounded and I'm hoping maybe you guys can kind of help me. I still need to get more information. But so I have a doctor who's a active client with us, right? I helped him set up a couple policies for his family a couple years ago. And he's at the stage in life where he's starting to, take some of his capital. He's done very well, OBGYN, and he's invested it. And he had the people that he invested with into I think it was a business one. He told me a couple of different models, but what they're doing now is they're coming back to him and they're like, hey, we're not going to pay you interest. Instead, we want to help you protect your family for the future and open an IUL on you. And we're going to give you the money to open the IUL. And so they did 2 times, 2 policies. And now in year 2, they don't want to. So he's done this twice now, like the last 2 years, I think. He's got 2 policies, a $500,000 and a $1.5 million policy. And now they want to do a 3rd time. They won't pay the policies in year 2, but they want him to do a 3rd IUL to put more insurance on his body. And he sent me these things because he's like, Jason, can we turn these into whole life? I'm like, sure we can. And now that I'm looking at them, the cash value of the $25,000 paid in is like $9,000,
Oh
and
my
the surrender
gosh.
value is like 16,000.
So it's got
Surrender charge. So he's negative like $7,000 in these policies.
So we can't even get the cash value out.
No. So what
Who's
do
the
we
beneficiary of these policies?
I mean, his family, but now he'll have to pay. I mean, they're not cheap. One's 15 and one's 25 a year, or 18. Like they're not small amounts annually.
Jeez, and he doesn't. Oh my gosh, that's crazy.
Like I'm just trying to navigate. I've been trying to like I wrote a big email about it yesterday. I was just like, what the heck? Like, what do you do? What do you do with this?
When you saw the 9,000 cash value there, what was that cash surrender value?
I'll read it right from
value.
That's probably the actual gross cash value. Net, of course, is zero because of the surrender charges, but it's probably a high base policy.
Current premium $17,500, accumulated value, cash value $9,092, surrender charge $15,660.
Yeah,
oh my God, that is so bad. That is so bad. I mean, honestly,
so they're getting massive. They're getting commission off of the money they gave him. Right. This is how I'm interpreting this. Tell me if I'm wrong, because I'm trying. I don't want to tell a story that don't have all the details. But
who gave him the money again?
The people he invested with.
Wow.
This sounds almost like very like in the red zone. Like
this is super in the red. This has to be super in the red. Like I don't know where to go with this. That's why I'm asking you guys. I'm at least trying to make it feel fun. Like this is.
I'm
crazy.
thinking they've invested together in an entity like a business, an LLC, and now that LLC is paying for some cross purchase policies or something like that to ensure the business owners. Like if I'm thinking on the positive side that there's actually a proper interest here, but I'm not sure that it's that good.
I mean, from a legal perspective, this might be one of those ones you'd run through an attorney.
Yeah.
Because that sounds very suspicious to me. I have a client where they did a 1035 from Lafayette to another insurance company. We ended up going back to Lafayette again because the other agency, when they did this, you're like that made no sense. You went from a good policy to a bad policy. If that client had pursued it, that agent would have been in serious trouble because they.
Yeah, and I'm going to keep names and stuff out and companies out because again, I'm trying to navigate this personally right now, and I don't even know what to do with it. Like, I'm an investor on some funds, One Cannabis and other companies lending money to the farm secure with land and other assets. As a member of the investment group, the offer to pay for 1 or 2 years of the insurance. And they funded both of them. So he's got 2 insurance policies that they offered to fund. And now, I mean, he has insurance. If he keeps paying the premium, I guess he has insurance, but he's already 65. So
I'm just trying to understand why they're the ones funding it and what the benefit is to them. Unless they're a partial beneficiary.
Because he's also a member of the fund, the business. So there's an insurable interest.
Yeah. So make them pay.
He owns the policy, though. They don't.
Right.
So I mean, that just blows me away. Then I mean,
that would work like an executive bonus, essentially.
Yeah.
Yeah, because it almost sounds like even some of the sports teams, like even the Jim Harbaugh, where the university paid for his policy, but it wasn't an IUL.
No. So, yeah, I mean, I don't on that one, man. I mean, it almost sounds like an attorney question.
I think so too.
I'm going to point him towards one because there's like he won the 1035 but there's nothing to 1035.
Yeah. All right. Let's go to Christian's question here. It says, if I'm understanding Craig correctly, I think we can add the interest to our policy loan principal if it makes sense.
I didn't understand that question. I read that earlier.
He's responding to Lynn.
What this is saying, or what Christian is saying here is like, say, if you don't pay that simple interest of the policy loan at the end of the year, it just gets rolled into the policy loan principal.
That's true.
Yeah, and I think that's what she asked right here. She said that's what she did last year as well. Like my policy, by the way, just did the same thing here in April. It rolled automatically the interest into the balance, and it was $110, so I didn't really care. Okay, let's go ahead and go to Ashley's question here. Ashley, I think we know each other. She's one of my best friends and my neighbor. So when people get Yeah. She's about my wife's best friend too. So when people get more than one policy, do they use each policy for different uses? Example, one for emergency funds, one for real estate, etc., or is that limiting use?
I love this question.
Yeah, it's a good one.
Yeah, it's a cool question. And I think it depends on the person. Like I've talked to individuals who have vacation funds, they have investment funds. They kind of like to separate their money, like putting it in an envelope. So they use their policies like an envelope system for the things they're doing. I look at it as it's one pool of money. And while I did start them for different reasons, some like the fund in future for Connor, right? Like that's one of our things. But the way we pay them back just kind of depends on where we want the money to go, what we're looking to do. It's like one simple family fund that we use them all for. But I've heard both ways. So
Yeah,
I have one policy that I don't touch. It's not a great policy. I want to get rid of it eventually, but I don't touch it, the cash value. I just let it sit there. It's my emergency. If I need a liquidity from something that's outside of all the banks and everything, that's what that one's for. So I do have that. And I have another one right now that is just gobbling up business debt, just paying it back. So I use those two separately. The third policy that I want to get, but it's just kind of challenging right now, would be for a completely different purpose, investing purposes. So, yeah. But it just depends on their situation. You know, Ashley, I know your situation. So your first one right now, we already kind of know what that one's going to be for. But down the road, as more in cash flow changes, then a second policy could be for a completely different reason.
it's going to be just building up your foundation, Ashley. Think of it as like an opportunity fund, and it could be for urgencies or emergencies or whatever else comes up in your life. Like things are going to happen. Like the one guarantee in life is change, especially if you're hanging out with the Fouts family. Like you're going to have some stuff go down, you know? So, and Danny as your best friend. Oh man, that's got to be fun. So anyhow, like the point being is life's going to keep changing. Things are going to change. You want to have a place you can go where you don't have to ask permission to get money, and you don't have to go whatever the rates are, and you just don't have to do and jump through all the hoops that you normally would. So.
And we understand if you have like little things break down at the house, Mr. Fouts is available for handyman services.
Actually, she's going to come over and help me fix my well pit potentially today.
That's awesome.
Yeah, she's here at my house today. Yeah. So, all right, Ashley, let's do the mobile home investments we've been talking about. Let's start doing those. There's quite a few here. There we go.
And I'm back looking at this guy's in-force illustration for this. Mm-hmm. Outlay $15,089 a year. On the guaranteed side, he's going to be in year 2. By the end of the year, he'll be 67. By the time he's 76, lapse.
Ugh.
From that perspective, if I were him, I would not pay the premium on the next one unless you have a desperate need for death benefit.
No, he doesn't. He doesn't. He definitely doesn't. Yeah.
Do you know what that reminds me of? Term policy. The only way it benefits you greatly is if you die early.
Yeah.
If you live too long, you're going to lose a ton of money.
Nope. My man is healthy. He's a healthy standard non-tobacco. So
that's just, my goodness. All right. Let's go to Anna's question here. It says, if you have a large, like say 500K HELOC and percentage is less than the percentage in the policy. So what she's referring to is the policy loan is like at 7% and the HELOC is at 6%. Which, by the way, is not very common for them to be that direction. Typically, the HELOC is more than the policy in current HELOCs I've seen. Would you recommend using the HELOC availability for investing in private money, leaving the policy cash value to grow? Well, that's a great one. So who wants to address the last part of that? Because that's a big point to make.
I want to address the first part at some point. Yeah. So if your HELOC rate is currently lower than your policy loan rate, I would be willing to bet that that's going to flip as soon as your policy passes its next anniversary, because that's when the policy loan interest rate gets adjusted each year. I would be willing to bet that that's going to switch, because HELOC rates are just across the board higher than policy loan interest rates.
Yep. She also mentions that her policy is in the first year and does not get efficient until the fifth year. So the policy getting efficient has nothing to do with you using the policy, by the way, because if you borrow from the cash value or not, the growth is still the same. So leaving the cash value alone, meaning not borrowing from it, is not going to change the value of the cash value in year 2, 3, 4, 5. It doesn't change it. So what the policy does that the HELOC does not. The HELOC is a required payment. It's a public loan, public strategy. There you have to make a payment, and the bank owns it. Your policy loan is owned by you. You choose when and how to make the payment. It's private and it's protected, and you are the one in control. So even if your policy loan is 1% higher than a HELOC, if you have enough in a policy, I probably use that first. But once again, if you're thinking about velocity banking, all these other concepts, you can start to put all of these concepts together and create an overall system that works together. So right now you're thinking like in bubbles, HELOC bubble, infinite banking bubble. But what if those are in one bubble and you're using them all as efficiently as possible? So that's called we call it the one system, the all-in-one, all that kind of stuff. There's really efficient ways to use these things, because if you have 100 grand in the policy and 500K in the HELOC, you really have $600,000 of liquidity. So it doesn't mean use one or the other. It means how can you use the whole system efficiently. So if you have a money mentor, if your policy is through us and you have a money mentor, just hop on a call with them and go through that scenario and see what makes the most sense. And then the Vault software we have will actually map this whole thing out for you. And it'll show you the percentages, show you the efficiencies, all that kind of stuff. So hope that helps. Let's see here. Oh, okay, this is a Strawberry Sweet again. It says, my son has an IUL, but they told me I couldn't change it over. So what she's referring to is rolling an IUL 1035 exchange into a whole life policy for infinite banking. So she's asking, so they said I couldn't change it over. Is that not true? I didn't try to overfund it because I found out about infinite banking.
It's not, I mean, it depends. It kind of depends. Like you can change it over to a whole life, but it depends on what year you're in. What's the surrender charge going to be? Like you might have less cash value than it costs you to surrender the policy.
Yeah.
So it just depends. It depends on what you're trying to do. Like sometimes getting off the train, if it doesn't make sense to stay on it. I know people who hold on to their IULs for the 10 years to get past the surrender point, the surrender fee point, and just pay the minimum they can into it so they get something back out of it. Mm-hmm. I don't know. I don't know what the best way to do it is. Sometimes I just tell people you should tear the Band-Aid off and get done with it, move on, pay the tax, and move on. So anybody else have thoughts on that?
I think that's a key. We say that a lot. I'm thinking we need a new shirt that says "It depends," because we say that so often. But you're right. Yeah, there are going to be times where maybe pulling the Band-Aid off is the right answer, and then there are some people that can't stomach that surrender and want to hold on for 10 years. So you're right. It's a hard decision.
Yeah, Linus, anything?
I guess one thing I would think about is, this son, what's his age, and what's his age going to be when this surrender charge is gone or almost gone? And, are there any current indications of any possibility of health issues before then? If not, then it could make sense to just kind of bank on that strategy of waiting to exchange it for a whole life until later. But even now, there's a good chance that you could get an additional policy on him, an actual whole life that's designed for infinite banking that you just use while you wait for the IUL to get at a good enough place to cash out or transfer over.
Yeah, and the other thing too is, when they say they can't change it over, it depends on what question was asked and what they meant by you can't roll it over. Pretty much most IULs can be rolled over to another insurance company if they have cash value. What they may have said is you can't really do it because there's no cash value available. If the surrender fees are too high, cash value is very low, then there's no cash value. They're probably saying you can't change it over. Doesn't mean you can't go start a whole life policy though that's infinite banking focused.
Just no cash in that one to start.
Yeah, that would be just schedule a call with one of us. We can go through that scenario and just kind of help you understand the best route to take. So Ian LMM is asking, is there a way to roll over an IRA and open a policy without paying a penalty and taxes. So what you're referring to is a qualified retirement account, or QRA, which is what an IRA, 401k, solo 401k, self-directed IRA, those are all called qualified retirement accounts. They're under the purview of the IRS and all those rules and regulations. Infinite banking policies are private. So they're a private concept. They're called unqualified funds. And so you cannot roll directly from an IRA into a policy. You can do it indirectly by taking the money out permanently, taxes, and of course, maybe a penalty. Then it goes into the IRA. So it's just math, by the way, to see if it makes sense to do that or not, because you are taking a haircut off of the cash that you have in the IRA. If you're in your 50s, oftentimes it doesn't make sense. If you're younger, it can make sense. But it's just we have to give you the math and let you make your own decision, to be honest. The only other thing you can do is, well, one is, why do you want to get the money out of the IRA? So that's another question I'd be asking is, why do you want to get it out of the IRA? What do you want the money doing for you? Are you trying to just get it growing as a nest egg? Because there's other products that are qualified, such as an annuity that we do as well, that can move that money over, get it into a guaranteed environment versus if it's in the market, risk environment, get the guarantees, have guaranteed growth, and let it just grow. And then whenever you need income, then it can turn it into income. So once again, it depends. For sure. A good question, though.
Yeah.
All right. Oh, this is a good one. I like this one. So Kurt Spring was asking a question. He says, how do you self-insure for vehicles using your policy? How does it work for car insurance? I spend $600 a month on car insurance. What kind of car is that? Oh my gosh. I'd love to.
I'm guessing there's multiple cars, but maybe not. Maybe not. Maybe he'll tell us.
Who wants to answer that question?
Brian, you seem pretty fired up, but go ahead.
No, I mean, we've answered it before. I think, Linus, you've answered it before.
Yeah, we even talked about it earlier tonight. Like, you can even have a specialized policy.
Go ahead.
Oh, you could even have, like you were talking earlier, some people set up a policy that's specific for like going on that trip every year. Yeah. But you could set up a policy.
Self-insuring, though, you've got to meet the reserve requirements for liability, just like the insurance company does. So it takes a pretty good pile of reserves to satisfy the state requirements on liability. And that's something you can look up. And that's not even talking about insuring the value of your vehicle. So it takes a lot of reserves to do it. I'll tell you that. I don't know that the return is really worth it, but it may be.
So I worked on that. I was thinking the premium dollars for a policy with an insurance company. You're right. I missed the self-insured part. So
you can there's more than one way to self-insure. I mean, life insurance is a way to do it. You can do it through bonds, by the way, as well, if I understand correctly. So I can't remember who did that. But you essentially have to show that you have the liquidity to cover the minimum liability in your state, or for your minimum state liability coverage. You have to show liquidity for that. That can be actually there's paperwork you can have, and typically an attorney will set this up for you. You can have there's a bond certificate you can have something on your life insurance you can have it, but you have to have it in your car to show that you have that kind of liquidity and that kind of coverage available. So most people don't do self-insurance because of that. Now, the wealthy people will often do that because they have so much net worth, they can show that very easily. And so like the Lamborghinis are not insured, but they are covered. They're just not insured the way that you normally would.
Yeah.
But yeah, it is eventually an attorney question, if I remember correctly. But I do know I have some acquaintances that are self-insured.
Good. I've always wondered about this one because it never made sense to me. So that's good. I got a little bit more clarity.
Yeah.
I think Nelson Nash actually talks about it briefly.
He does.
I don't think it's in Becoming Your Own Banker. I think it's in one of the other books, but I'm not even sure. I couldn't find it just now.
Yeah.
I think it's in the car example of Becoming Your Own Banker, if I'm not mistaken. I think it's towards the end of that example.
I don't remember. It's a good question to think about, but once again, it's going to be specific to that person and your liquidity, your net worth, and all that kind of stuff. Because you can even have a business can actually self-insure vehicles because of that. The business has capital.
Yeah.
MRC is asking, my 21-year-old grandson already has his own banking policy. Oh my gosh, it's awesome.
That rocks, doesn't it? It's crazy.
Oh, it's awesome, but at the same time, I'm like, God, I wish I could go back in time. Yeah. So he tells me he's ready to start a second. Wow. I'm wondering if it would be wise for him to get it on his mom.
Think even further. wouldn't it be wise for him to get it on you, the grandmother?
There you go.
Yeah.
That's actually awesome, Linus. That's actually
Yes.
really, 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 it's because that's going to come right back, right back sooner than mom, maybe, so.
Yeah, I mean, family banking right there at its finest. Now, the question would be, why, right? It's always going to be, what are we trying to accomplish? All that kind of stuff. Because if he does it on a grandmother or the mother, then it's not tied to his life anymore. So the policy, and I need to be very blunt here, that policy might not be in effect or in force as long as it would be if it was on him because of life expectancy. But once again, though, that can be a strategy.
Right. But the way I would look at that is if he's then the beneficiary, that death benefit payout is now like way bigger than what he put in.
Yes.
Then he can deploy that into more of his own policies. Maybe he has a family down the road. Like it just changes the dynamics quite a bit. Like my father passed away unexpectedly, aggressive cancer. It's just over 1 year now, and he was only 51. He was against life insurance, so it wasn't even a possibility for him to have coverage or for me to have coverage on him. But I think about it from time to time, like how much different some things might be for my family, even if it's not necessarily for me, for my family, if this would have been put in place just a few years ago or something.
Yeah. Yeah, Linus, thank you for sharing that. And when I look at it, just to make it like label it, like the 21-year-old's generation one at this point, if there's not life insurance on, his mother and on you. But as soon as life insurance goes on you and maybe his mother, he all of a sudden becomes generation 3.
Yes.
Because there's going to be a cascade, and like you're creating generational wealth by putting a very small amount in now for something that is going to happen at some point. That's what Linus was talking about. A little bit more long range thinking and looking at the whole picture. And you're going to change generations down the road just by thinking that way.
Yeah.
It's a really, really, really good question. And it's a powerful thought process.
Yeah. So the one challenge MRC he's going to have here is, the premium is going to be larger on you or his mother versus on him. So there's going to be a significantly higher commitment. Now that might be okay. Once again, we don't know the numbers right now. We don't know the numbers. But yeah, the minimum would be 10 times the age. But once again, we don't know if that's the right number. The right number is what number he wants to put in to accomplish his outcome. Yeah. So if you have a mentor, if he has a mentor with us already, just hop on a call with him and go through the scenario.
And less is possible as far as premium goes when there's maybe less of a focus on it, even using it for infinite banking in the short term. So, depending what the reasons are behind wanting to do the policy, there's more flexibilities there.
Yeah, good point. Oh, so Kurt did say, car, boat, camper, truck, golf cart, it adds up. Yeah, I'm sure it does. And he did mention, he said, this is why he brought it up, because it does talk about it in the book. Yeah, that's where I kind of remembered it. I can't remember. I talked to an attorney friend of mine years ago about the self-insuring thing, but he just said, you have to have documentation that's put together, not just like a statement of your life insurance account. You have to have some sort of documentation put together that shows it.
And I do remember, because I've worked in the insurance industry for so many years, one of the companies I worked for that was, it was actually, I think it was a privately held company. They self-insured the medical insurance, and they did it for about 10 years. But in the 10th year, they had 2 or 3 premature babies, and that destroyed the entire plan, and they had to go back to the other world.
Law of large numbers, because their numbers probably were not large enough.
Exactly. Yeah.
That's crazy.
They weren't funded properly for that kind of a hit, and they got hit in that 1 year, and it was enough to take it down.
Yeah. I remember when my wife gave birth the last time. I remember I saw the bill, insurance covered it, but I saw that thing. I was like, oh my goodness. And this was 10 years ago, and it was over 35,000. Premature, that's got to be in the hundreds.
From what I remember, just one of those preemies was over $1 million.
Oh my goodness.
Because there's a lot of time in the hospital depending on the timing of that.
Yeah, that's brutal. All right, Strawberry Sweet has a question. This is a follow-up to the IUL, her son. So $125 per month. He's 30 years old. I think I've had it for 3 to 4 years. That's what I was thinking about, getting an infinite banking policy for him. So yeah, just schedule a call with one of us and we can help you out with the numbers on that. Because yeah, 125 per month at 30 years old, like we already know that's not going to be, even in IUL, it's not going to be building cash value because there's just not enough going in. There's not enough fuel going into the infinite banking or the policy itself to fuel it for cash value. Because an IUL can have good cash value if they're done correctly, which maybe 1 out of 30 is done like that. But even then, they're still not the best vehicle for infinite banking. So yeah. Well, guys, I think we made it to the end.
Yes, we did.
26 after.
I had a comment on Kurt's, the self-insurance. Because, I mean, every time I go back to becoming your own banker, I said this to a client earlier today. Every time I read like a paragraph I might have read 40 or 50 or 60 times, because I'm in a new place, like my thinking has changed. I'm always picking up something new. And so like that self-insurance part, I don't fully understand. I've heard David from the Nelson Nash, for the Nelson Nash Institute talking about it and how they've done it with their family, but they've been doing this for generations. Like they've been doing this for a long period of time. So decades upon decades. And so when I see some of the use cases later on, what I tell myself, Kurt, is I'm not there yet. I'm going to understand it when I get there. But right now I don't fully understand it. And like what they're saying is you have to have a big pile of cash. And my mind instantly said, maybe this is just dumb, but my mind said, well, why would I self-insure if I could have someone else cover it for a smaller amount? Because if someone can take what I have from me, it means I don't own it. So even I'm paying $600 a month or $7,200 a year versus having to have however many tens of thousands, hundreds of thousands liquid to cover the self-insurance. That's how I'm understanding what Linus and Tess shared. So for me, I would just say, if someone can take it from you, then you don't really own it.
Yep.
And it's interesting. You brought up something good. It took their family a long time to get there, because when I was at that Nelson Nash coaching recently, they actually diagrammed their policies for their family. And I want to say they've got like 30 members of the family that are practicing. So you're right. They have a big pool that they were building.
It's over time. And that's why Nelson was brilliant. Every time there was a new insurable interest, they were insured, and it's uncomfortable every time, by the way, folks.
Oh, yeah.
We're up here espousing the benefits and how like it's changed our life and what it does. It doesn't mean it's always easy.
Yeah.
It doesn't mean it's always easy. It means that there's going to be things you're learning, because if you're not a little bit uncomfortable, honestly, you're probably not doing life the right way. I don't know any scripture or anything that talks about life being easy.
Right.
Yeah.
Right. Life is an ongoing challenge with new problems to solve. And the better we are being uncomfortable, the better we are being uncomfortable in our life, then the better our life is going to be, because we're not going to be thrown off by everything. So when we talk about control, we talk about guarantees. That's why we want you to have the opportunity to speak with us, because we can give you that. We can give you what we have in our family. It still doesn't mean it's easy, though.
Yeah.
We haven't found that passage where you get to sit down with a remote control, a pillow, a blanket, and a box of bonbons.
No, it doesn't exist. All right, everybody. Well, appreciate all the questions. For those of you that were new here to this Ask Me Anything, welcome, and grab that link in the chat box and grab a time with one of our mentors. But with that, we do this call every single Wednesday live stream. So go ahead and hop on next time, ask more questions, keep on learning. With that, take care. Appreciate all, everybody.
Yeah.
Take care.